Welcome to another session of Business Startup Training. Today we're going to be talking about an exciting topic of bad debt and the provision for bad debt. Like, share, subscribe. Again, this is presented by Accounting Lecturer. Okay, let's get into the main concepts we're going to look at today. So we're going to look at bad debt. First, we need to define it. Then we look at bad debt in terms of the principles. We're moving on into the ledgers to kind of grapple with that as well. And then we move on to bad debt and accounts receivable. And then we move on to the concept of the aging report, which is an important idea. Then we move on to the principle of bad debt, provision for bad debt when we increase a provision. Then we move on to the decrease in the provision, and then we look at the impact in terms of Xero Accounting Software, the provision for bad debt and bad debt in terms of the impact on the income statement, and then we'll conclude. Okay, now let's first of all define what is bad debt. What's bad debt? Now, bad debt is defined as bad debt is receivable that a customer will not pay. Bad debt are possible whenever credit is extended to customers. They arise under the following circumstance. Okay, so in order for bad debt to occur, one thing needs to take place. A customer needs to buy goods on credit. When a customer buys goods on credit, business gives the customer the goods and the customer is yet to pay. When you have an instance like that, if the customer for some reason or another cannot pay, we would consider that debt to be bad. And that's how the principle of bad debt comes into play. That's the main idea. Now, we need to talk about it in terms of the ledgers because that's quite important. Now, let's look at this example. We have two persons or businesses that we sold to on credit, but we'll use names to represent them. So first we have James Luke, or J. Luke, James Luke, but let's say J. Luke. And we sold him on the 1st of Jan 2021, 2000, and M. Brown on the 3rd of Jan 2021, 3,000. Okay, so let's consider the impact. Now, in terms of the ledger, so we have a ledger for both of these persons that we sold to, or businesses we sold to on credit, J. Luke and M. Brown. Now, we now recognize that we're not going to receive the money. Time has passed, months have passed, we're not going to receive the money. We now need to write this off as bad. We then go into their account. We go on the opposite side of their account because the fact is, when they get the goods, they get it on the debit side of their account. So we need to go on the opposite side of their account on the credit side, and then we would need to debit the bad debt account. So the bad debt account is always a debit account, and then we transfer this information to the trial balance, eventually to the income statement as an expense, which we'll talk about later on. We also need to take into account another principle. Now, because it is that we consider this debt is bad, we have an aggregate of the debt previously in a control ledger, which we normally refer to as the accounts receivable ledger. So in the accounts receivable ledger, it would be incorrect that this money is to be received because we've now discovered that we're not going to get this money. So therefore, we need to adjust the figure in the accounts receivable ledger by this amount. And here in this example, the total bad debt is 5,000. So we need to adjust the accounts receivable ledger by 5,000. And so here you can see it in red on the 30th of June, 2021. We've realized it's going to be bad. We've adjusted the various accounts, and we also need to adjust the accounts receivable ledger. Now let's talk about another principle. Here we'll talk about what is called the aging report. Now the aging report is more on a scientific side, where we have a breakdown of all the individuals or companies we sold to on credit and the time that has lapsed between the goods received or the service provided to them by us and the time we're waiting to receive the money from them. So we could have sold to them in a month, 2 months, 3 months, 4 months, 5 months, over a year period that we've sold to them, and we are yet to receive the money. Now, when you have such a varied categories of customers that we've sold to on credit, we need to kind of establish, based on historical figures, what proportion of this we may not receive. And here we generate the principle of provision for bad debt, or an allowance for bad debt. So we have two scenarios. We have one scenario where we conceive that the debt is bad and therefore we're not going to get the money. We adjust the ledger. And here we have a concept whereby we provide for the debt will not be received, and so we prepare for it by creating a provision for bad debt. Now here we have a list of individuals or companies that we sold to on credit. So we have Mike L, James F, Luke P, and Mary J. We sold to them 3,000, 6,000, 4,000, and 3,000. Now on the 1st of Jan, we sold to the first one, which is Mike L. So it's 6 months that we've not received the money. We assume that it's likely that we may not necessarily receive all of it. There might be a problem. And so we say maybe about 15%, there's a 15% probability we may not recover the full amount. So let's estimate or prepare for 15% we may not receive. And the same for James F. Say 6,000, so let's say about 10%. 1st of May for this one, which is Luke P, 3% because it's relatively recent. And the 1st of June 2021, Mary J, 3,000, let's say about 1%. Now, once we have those breakdowns and we've attached a percentage to it, and now you might be wondering, how do we get a percentage? It's scientific, it's via experience, it's what has happened historically, and you're able to generate a percentage accordingly. Now, here we have the figures of 450, 600, 120, and 30. The aggregate of that is 1,200. So 16,000 was owed. We estimate about 1,200 we may never receive. Okay, and that's based on the calculations that we had, which is the 15%, the 10%, the 3%, and the 1%, which works out to be 450, 600, 120, and 30. Okay, so now that we know we may not receive this, we need to put it in a ledger. Okay, so we gotta create two ledgers, and here we introduce the idea of the ledger. Now, it is important to note that the allowance or the provision for bad debt is a credit account, generally, because it has an impact in the statement of financial position as well, which we'll talk about a little bit later. So we know naturally it's a credit account, but there are changes in the scenario because we may have a situation where we prepare for the debt that is going to be bad and it's not bad. And so there is a situation where our estimate might be accurate and our estimate might be inaccurate. And those inaccuracies cause the principle of increase or decrease to take place. So we might prepare for the debt being high, but it is not high. And we can also have a situation where we prepare for the debt and it's low, or we prepare for the debt and it's high, so anything can happen. So, we can have an inverse of what we prepare for. So let's look at this situation. So we know the allowance is always a credit account. So we go on the credit side of it. Because this is a new situation where we're estimating, it's an increase. So that increase is 1,200. So we go on the credit side of the allowance account, 1,200, and then we have the increase in provision on the debit side, all on the 30th of June 2021. And then we move on to some other principles. Now, because of time, we may need to stop for a minute and then we'll come back to the ideas, but I would like to have you hold on and come back again so that we can further discuss the principle of bad debt and provision for bad debt.